Okay, so this week topic is on measurement of business income, which is basically what you will learn in this lecture is um, on here. Okay, you will learn what is revenue, what is expenses, and what is profit. So basically, all these elements they are what we report in the income statement. Okay, so after you understand what is revenue, expense, and profit, then you will learn how to prepare the income statement, which is I think I always mention that income statement is to measure the performance of the company, which is the performance is measured by looking at whether the company is making profit or loss. Okay, and then after before we can prepare the income statement. Okay, so remember that you have prepared the all the ledgers and then prepare the trial balance. But before we can prepare the income statement, you need to make some adjustment. Okay, because remember that because we apply the accrual concept, so at the end of the year, before we prepare the income statement, we have to do the adjusting entries. Okay, we adjust all the accruals and all the prepayments, and also we do the if there's any estimates such as like provision for doubtful debt, depreciation. So we do all those estimates at the end of the year. Okay, so those are the major types of adjusted entries. Okay, like I mentioned just now, the accruals, prepayments, and also the estimates. Okay, so to provide timely and also meaningful information to the users of the financial statements, then the company and also the business operation of the their report have to be divided into a time period. Okay, a specified time period. So the financial statements, usually we prepare it monthly. If there's so many transactions, we can do it monthly. Okay, but some company they do it quarterly, half yearly, and also annually. Okay, but because why we have to do this I mean, for this time period, because there are many transactions that cross from one accounting period to the next. Okay, so that creates problems to the preparer of the, uh, create problems to the accountants and also preparers of the account. So that's why we have to divide it into period of time. But it's, yeah, it depending on the size of the business and how many transactions that they have. Uh, so the revenue and expenses, what are they? So revenue represents here the price of goods sold and services that the company rendered to customers during any given accounting period. So this revenue, when they have this revenue, it will increase the owner's equity. Okay. So let's say if they have sales, okay, or if the company provides services to customers, or if there is any interest revenue, whereas dividend revenue, so that will increase the owner's equity. Okay, why the expenses, they are the cost of goods and services that use up in the process to earn the revenue. Okay, so that's why the preparers of the accounts and the accountants, they will try to match the expenses that are incurred with the revenues generated in the accounting period. So it must be in the same accounting period. Okay, we try to match expenses and the revenue in the same accounting periods. So these expenses, like for example, salaries expenses, administration expenses, rent expenses, those all expenses will decrease the honest equity. So remember the honest equity, when I think in the earlier lecture, when I give you the accounting equation, I said that the honest equity is from the revenue minus expenses. Okay, and then you plus uh, with uh, with the capital contributed by the owners. And then, okay, So we have to report the revenue and expenses in the income statement. Okay, so that we can measure how much the profit or loss that the company made. Okay, so to calculate the profit or loss, you have to match the revenue with the expenses in the accounting period. So this is what we call matching principle. Okay, so revenue we match with the expenses. If the revenue is more than expenses, then the company is making profit. If the revenue less than expenses, then the company is making loss. Okay, so the income statement, there will be gross profit, operating income, and net income. Okay, we report this gross profit, operating income, and net income. What is gross profit? Okay, gross profit also known as gross income. So this gross profit or gross income, this is the difference between sales revenue and cost of goods sold, which is sales minus cost of goods sold. And what is cost of goods sold? Cost of, cost of goods sold is the purchases plus the inventory balance. I mean the purchases plus beginning inventory, and then you have to minus any closing inventory. So that will be the cost of goods sold. Okay. While the operating income, this is the performance of the core operations of the business, which is the gross profit minus all the operating expenses. Then we get the operating income. Okay. All right. And what is net income? Okay, net income, yes, as you can see, as you can read from this screen, it is an economic performance of a business for a certain accounting period, which is the operating income. When you have the operating income, which is after deducting the operating expenses, so we have the operating income. So this operating income, we deduct all the non-operating. Okay, we deduct all non-operating expenses and we plus any non-operating revenue, then we get the net income. Okay. So the non-operating here, what I mean non-operating is like interest and income tax. Okay, so operating income we minus the non-operating, like if there's any interest expenses, and also tax expenses. So we deduct that these two as non-operating expenses. All right, and if let's say if you have the non-operating revenue, then we have to add it. Okay. Yeah. So the expenses are the losses from other operations. So that is also called as non-operating, because non-operating here means that the expenses and losses, those are from not from the main activities of the company. Okay. All right. So let's see here the how we calculate the net income or net profit. It's the same thing. If I mention about net profit, it also means net income. Okay, so the revenue, let's say sales. Okay, sales minus cost of goods sold. So to get the cost of goods sold, because some question we straight away give amount of the cost of goods sold, but some question you have to calculate by yourself. How much is the cost of goods sold, which is what I mentioned just now. Cost of goods sold consists of the beginning inventory plus purchases minus closing inventory. Okay, we get the cost of goods sold. Okay, revenue minus cost of goods sold will equal to the gross profit. So the gross profit minus operating expenses, then we get the net operating. Okay, net operating profit or operating income. Okay, so this is net operating profit is in other words it's operating income. Okay, so this operating income we minus the non-operating expenses and losses. Okay, and then if there's any non-operating income, we have to add it. Okay, and then we get the net income, but this net income is before the tax. Usually we separate the tax from other non-operating expenses. Okay, because just now I gave you example like non-operating expenses such as interest expenses, tax expenses, but usually we have to report it separately. Okay, because we need to know how much is the net income before tax. Okay, so net income before tax, then we minus the income tax expenses. Okay, and then lastly we get the net income after tax. Okay, net income after tax or net profit after tax. Okay, so this is the bottom line. The net profit here will be the bottom line of the company. All right, so here All right, firstly, we have to calculate the gross profit. Okay, so the gross profit of the section when we calculate the gross profit, this is what we call trading account. Okay, so that's why sometimes when we prepare, we call it trading and profit and loss account. So trading account here represent the section when we calculate the gross profit, which is here. Okay, revenue, let's say sales revenue or service revenue, depending on the business of the company. Okay, so if they have a product, sales product, so it will be sales revenue. If they provide services, it will be service revenue. Okay, and then we minus the cost of goods sold. So yeah, cost of goods sold is the beginning inventory plus purchase. Okay, inventory, beginning inventory plus purchase, this is what we call it cost of goods available for sale. Okay, this is the total cost of goods which is available for sale. And then we minus the closing inventory, okay, or ending inventory. Minus closing or ending inventory, then we get here, the X here represent the cost of sale or cost of goods sold. Okay, so the inventory at the year end we minus, and then we get here finally cost of sale or cost of goods sold. Then we minus cost of goods sold from the revenue, then we get the gross profit. All right. All right, the note here, sales and purchases are after deducting the return. So let's say here the revenue, if you have the sales return, okay, so the revenue here is after you deduct the sales return. So let's say you have the sales and you also have the sales return. So sales minus sales return, so the revenue here will be at net. Okay, net revenue or net sales. Same for the purchases here. The purchases, if you have the purchase return, you have to minus purchase return here. Okay, purchases minus purchase return. So you have to add the net purchase. Okay. Let's see the example. Okay, has S man whose accounting years ends on 30th April buy and sells one type of aluminium engine head for sports car. So on the 1st May, there were 50 units stock. So the cost per unit is 100 ringgit per unit. So during the subsequent accounting year, he purchased additional 500 units. But the cost per unit is also same. 100 units also 100 ringgit also per unit, and then he sold 450 units. Okay, the selling price is 150 ringgit. So 100 units, the cost of which 100 ringgit each has not been sold at 30th April. Okay, so now let's try to calculate the gross profit. Okay, remember the gross profit is what we call it under trading. Okay, trading statement or trading account. So here, the total units sold is 450 units. Okay, units sold is 450 units. So it was sold at 150 ringgit. Okay, so 450 multiply 150, so we get in total 67 ringgit, 67,500 sales revenue. Okay, and then we minus cost of goods sold. Now let's try to calculate cost of goods sold. Okay, cost of goods sold, we start with the beginning inventory. So it says that at the beginning they have S-Man have 50 units. So 50 unit at the cost of 100. Okay, 100 ringgit. So 50 multiply 100 ringgit, so it will be 5,000. Okay, and then the new purchase, okay, the goods purchased during the year, 500 units. Okay, so 500 units, sorry, the 500, yes, 500 units multiply also at the cost of 100 ringgit. So 500 multiply 100 ringgit, so we get here 50,000. So 50,000 plus 5,000, cost of goods available for sale is 55,000. Okay, and the total units is 50 plus 500 is 550 units. Okay, and here 55,000 in terms of the amount. Okay, the cost amount, and then we minus ending inventory, which is inventory at 30th April. So it says that inventory at 30th April is 100 units. So 100 unit at cost. Okay, 100 multiply 100 ringgit. So that will be 10,000. So 55,000 minus 10,000. We have the cost of sales of 45,000. So 45,000, which means that we have the balance of we have the unit sold. Unit sold 450 units. Okay, so we compare. The unit will be same as the sales sold unit here. Okay, 450 unit for the revenue, and cost of sale also 450 units. But the cost of sale is the at the cost price, and the revenue is at selling price. Okay, so the revenue 67,500 minus cost of sale 45,000, we get the gross profit of 22,500. Okay, so that is how we calculate the gross profit. Alright, alright, so far any question? Anyone has question? Can you all follow?
Yes, doctor.
Okay. If no question, then let's just proceed. So revenue and expenses here. Some other common peripheral transaction. Okay. Um, Peripheral transaction here is means what is normal transaction. Okay, normal transaction, but it's not core. You understand? It's a normal transaction, but not part of the normal operating activities. So this common peripheral transactions such as gains and losses from selling assets of the business. Okay, let's say if they sell um, vehicle, if they sell the equipment. Okay, you understand? Because you know, if the main operating is to sell product. Okay, um, but when they sell the assets of the business, so this is what I call that it's a normal activity, but it's not part of the core operation of the business. Okay, so the results from this peripheral transaction, it will be either gain or loss. Okay, so a gain is when the business sells something that um, when the amount is when they sold the something, it's the amount of the sale is greater than what they record in the accounting record, which is in other words that the market value is uh more than the book value. Understand? If the market value is more than the book value, then they will have a gain. Okay. So for gains, just like revenue, the gains will increase the net income, or in other words, the gains will increase the honest equity. Okay, and the loss here, if they have a loss here means that uh, the business when they sell the asset, the selling price is less than the what they record in the accounting record, which is in other words the market value less than book value. Okay, if market value less than book value, then it is a loss. Okay, so just like expenses, losses will decrease the net income and also decrease the honest equity. All right, so here, this is how I mean we report the peripheral result. So here the example is given here is interest. Okay, so what I explained just now, if let's say it's gain and losses if you dispose the assets, if you sell the assets of the company. But sometimes, for example, like if the company invest in other company, okay, but the investment is not core of the business. Okay, so if they invest in other company, they will get interest revenue. So interest revenue is what we call it peripheral transaction. So the interest revenue will be reported down here, okay, as other revenue or non-operating revenue. Okay, same for the interest expenses. Interest expenses, let's say if the company borrow make a borrowing. So borrowing is not main operating of the business. So the interest expense will be reported under non-operating, okay, or other expenses. All right. So next, yeah, same for the income tax as well. Okay, income tax also is part of the um, is considered as a non-peripheral as well. Okay, so we have to report it separately. Okay, the reason why we report it separately, because yeah, because we want to see the um, we have to separate the income tax from uh, the core transactions and also other peripheral transactions, because we want to see you know, how much is the total income before the income tax expenses. So that's why we show it separately. Okay, because the income before income tax, okay, income before tax, that will determine I mean the number for the income before tax to determine the income tax expenses. You understand? So that's why you have to show it separately. The income before tax, the amount of 3840 here will be used to calculate how much is the income tax expenses for the year. Okay? All right. So here, realization principle or recognition principle. Okay, realization or recognition principle. So one of the basic concepts of the accounting here means that the revenue should be recognized or the revenue should be realized when the goods or services are sold to customers. So here the concept here means that um, especially it will be difficult if the people only follow the cash basis. Okay, because for this concept it's more on accrual basis. Okay, here means that we only recognize the revenue when the cash is received rather than when it is earned. Sorry, if the cash basis is means that revenue is recognized when the cash is received, but for the accrual basis we recognize the revenue when it is earned. Okay, and also we recognize the expenses when it is incurred. Right, you understand? All right, so for you to clearly understand what is this realization or recognition principles, let's look at the timeline here. Okay, so here the receiving cash. Okay, the cash is received in the same period. Okay, same period. Cash received in the same period as the promise act are performed. Okay, for example, like company perform and then the company receive the cash. For example, like um, for example, if you cut hair, okay, if you go to the salon to get hair cutting, so the customer usually they will pay a few minutes after you get the haircut, right? So this is what we call it's the same period. I mean the performance is the same period when the cash is received. Okay. So in this situation, because it's the same period, so the company will report at the same time increase in revenue and increase in cash. All right. Okay. So in this situation, this is the second situation because here sometimes the customer they will pay in advance. Okay, they pay in advance, which means that they pay before the company perform. Okay, for example, like okay, for example, like salon just now. Sometimes some salon they will give gift card. Okay, they sell the gift card, but the haircut service will be provided in the future. You understand? So the customer will pay in advance for the gift card. Okay, but the haircut will be will be done in future. So here, because here the customer pay in advance, which is in terms of the gift card, so the cash is received before the haircut is done, or the act performed by the company. Okay, so in this case here, because the cash is received earlier, so the company will report an increase in cash. Okay, and because the performance has not been done yet, so that will increase a liability. Okay, because a liability here because means that the company have an obligation to provide the services in the future. Okay, this is what we call unearned revenue. Okay, so after they, let's say if they have eventually performed the service of the haircut, then the company will report decrease in unearned revenue, then they will report a revenue. Okay, all right. And then in the third situation here, this is in the case when the customer pay for the services or good later. Okay, which means that they already got the haircut, but they haven't paid yet. So this is in case that perhaps you have a regular customer and you know this customer, so you allow the customer to pay perhaps next week or next month. Okay, so in this case, the company will report increase in revenue because they already performed the haircut. Okay, they already provide the services, so the company will report increase in revenue, and at the same time they will report increase in account receivable, because account receivable here means that they will receive cash in future. Okay, so this account receivable is asset account because they expect to receive in future in terms of cash, so it will be asset. Okay, so in the future when the customer pay the cash, then the company will report increase in cash, and then decrease the account receivable because the customer already made the settlement. All right, so that is the three situation between the revenue, recognition of the revenue, and the cash receipt. All right, so this is the matching principle. So the matching principle states that we must match expenses with the period which they are used. Okay, so we have to match with the revenue that that the expenses is used to generate the revenue. All right, so here the accrual base to measure the expenses, because we have to match the expenses with the revenue that the expenses generate. So here, as usually that the company have to encounter a variety of costs when they run the business. Okay, so the cost of an item here means that the cost is incurred when the company pay. Okay, when the company pay the cash, or perhaps the company use credit. Okay, use credit to obtain the expenses, for example. Right. So when the costs are incurred, then the accountants must decide whether to report these expenses as, these costs as should be reported as asset or as expenses. Okay. If the costs do not benefit future periods, if there's no benefit in the future periods, then we have to report it as expenses. Okay, so if it expenses, then we have to report in the income statement. Okay, but if you find the cost has benefit in the future, which is the cost has probability. It has probable future economic benefits. Then we have to capitalize it. Okay, we capitalize it as asset. Okay, we capitalize as asset and then we report in the financial position statement. So later, the cost here, the asset cost would be transferred to the expenses when uh, the asset's future benefits has been used up. You understand? For example, like the assets, like machine. When you buy the machine, because you know the machine has a future economic benefit because you use the machine to produce product, to produce goods. So that is what we call has future economic benefits because the ability of the machine to produce goods. But after a year, for example, after a year you use the machine, so you have used up the machine to generate revenue of the business. So the use up of the machine, this is what we call depreciation. Okay, so this is what we call, we'll transfer it to the expenses because depreciation is expenses. Okay, so the asset machine, and then when you use up, it will be depreciation expenses. Okay. All right. So remember that revenues are recorded when the business fulfills the promise to provide uh, goods or services to customers. Okay. So you have understand just now. It's not necessarily in the same period. If it's same period, it will be easy. Okay. If it's same period, at the same time we increase the cash and we increase the revenue. But if the cash is received in advance, which is before the company deliver the goods or services, how to do the record? Okay, how to prepare the account for this situation? Okay, if the cash is received before, okay, before the delivery of goods or services, then we have to do the journal entry here. Firstly, we record the cash receipt because we receive the cash in advance. So we record the cash receipt. We debit the cash and then we credit unearned revenue. Okay, so later when the service of goods are delivered, then we debit the unearned revenue and we credit the service revenue. Okay, and the third one, this is in case that if the cash is received after the companies deliver the goods or services. Okay, which is after the delivery of goods or services. So in this case here, the journal entry to record the delivery of goods or services. Okay, because we deliver the goods first. So we have to debit account receivable because we haven't received the cash yet. So we debit account receivable and we already delivered the goods or services. So we credit revenue. Okay. Later, when we receive cash from the customer, then we debit the cash. Okay, we debit cash and then we credit account receivable. We have to remove account receivable. All right, in case of the expenses, so same, in expenses also in the same, there will be three situations. We have the cash paid in the same period or cash paid in advance and also cash paid later. Okay, so for the first one, if the cash pay is the same period when the expenses is incurred, the journal entry to record this transaction will be we debit the expense and we credit cash. Okay. In the second situation, if the cash is paid before the expenses is incurred, then the journal entry to record the cash payment is we debit prepaid expenses. Okay, debit prepaid expenses and we credit cash. Okay. Why prepaid expenses? Because expenses is not incurred yet. It's not incurred yet. and you pay in advance. So it will be prepaid expenses, and the cash has to be credited because you already paid it. Okay, and then later when the expense is incurred, then the journal entry to record is you debit expense account and credit prepaid expense. Okay, the third situation here where the cash is paid after the expenses is incurred. So the journal entry to record this the incurrence of the expenses will be debit expense account and credit account payable. Okay, later when the cash is paid, then the journal entry will be debit account payable and credit cash. All right. So just now I have showed you. Uh, the adjustment that we have to make. Uh, so those prepayments and also accruals, those are the adjustment that we have to make at the end of the year. Okay. Um, so here the adjustment, what does it mean? Adjustment here is a formal entry that we made at the end of the period to show the financial effects of the um, yeah, explicit transaction. If we have the credit purchase, credit sales, and so on, and then we have to properly assign it to the appropriate time period. Okay, why we have to do adjustment? Because adjustment here because we have to to adjust for the timing difference. Okay, so that's why we do the adjusting entries at the end of the period so that we get the amount that we report as revenues and expenses are up to date. Okay, um, so here let's see the examples. Sorry. Before we see the examples here, let's see the further explanation of adjusting entries. So here, because this adjusted entry, because we use the accrual basis. Accrual basis means that the revenue being recognized when it is earned, and the expenses is recognized when it is incurred. Okay, so the accrual basis of accounting is complied to the generally accepted accounting principles or GAAP. Okay, so all these adjusted entries will involve the revenue and expenses, and also we involve the asset and liability. Okay, because when we have the prepaid expenses, because we paid earlier, so that is considered as asset. If we have accrued expenses, because the expenses has not been paid yet, so we have the obligation to pay in future. So the accrued expenses will be liability. Okay, and for the revenue, if we have revenue that the customer will pay in future, or in other words, we have um, accrued revenue. Okay, if we have accrued revenues, that will be asset. Okay, because the customer will pay in future, so it's considered as asset. But if we have prepaid revenue or unearned revenue, it means that if prepaid revenue or unearned revenue means that you have uh, the revenue that you have the obligation to perform service or deliver goods in future. So that is a liability. Okay. So this is just a further explanation what I have explained just now. Okay. So accrued revenue is asset. Unearned revenue is a liability. But if you for the expenses, if it's prepaid expenses, it is asset, and for the accrued expenses, it is a liability. Okay, so you can try to read by yourself here, so that you can understand why, why those are asset and another one is liability and so on. Okay. Um, any question before we proceed to the next slides?
No, doctor.
No. Alright, before I proceed, let me remind you, next week will be um your test. Okay, your test one. Uh, okay, hold on. Yes, test one. Because for this course, you will have two tests. So the second test will be the alternative assessment. Okay. For test one will be next week. So test one will be the questions will be on journal entries. So make sure that you know how to prepare the journal entries. Okay. So so this test two for you to sorry, for test one, for you to prepare for the test one, I have already provided the answers on the tutorial notebook. Let me share you where you can find the answers. Hmm, no, not this one. Okay, can you see the tutorial notebook on your screen now?
Yes, doctor. Yes.
Okay, so I put the selected answers here, up here. Okay, so you can check the answers for tutorial 2, 3, and 4. And then, okay, for tutorial, your answers, for the tutorial, I haven't go through yet. Actually, I've tried to go through all the answers given by you as soon as possible. But, okay, but can you please make it properly? Because here I find that it's, yeah, it's quite messed up. I mean, for tutorial 2, I assign only for group 1 and group 2. Okay. So group 3 here, I believe this is question for tutorial 3. So can you please move group 3, you move to the tutorial 3 down here. Okay. So for tutorial, yeah. So tutorial 2 is for group 1 and group 2. So group 3 to group 8, can you please delete? Okay, your answer from here and you put your answer um to the your tutorial that I have assigned accordingly. Okay, so tutorial 3 is for group 3 and 4 and tutorial 4 is for group 5 and 6. Okay, so can you make sure, I mean, properly move the answers to uh, yeah, to the tutorial.
Doctor, I have a question for the tutorial
Yeah,
5. Must we open our own section?
tutorial what? Can you repeat the question?
For the tutorial 5, must we open own section or doctor will open for us?
Section. You can open the section by yourself. Just click the section here. and just write your tutorial class, slot 9 to 11 or 2 to 4 or 4 to 6. Okay.
Okay, doctor. Thank you.
Yeah. Um. Okay. So you move accordingly the answers to the correct tutorial, and then I will give the comments accordingly. Okay. And for you to prepare for the test, you can refer to the answers that I provide here. Mm, whereas because the reason why I ask you to put your answers here, because I just want to see how you answer the questions. Um. Okay. Whereas I think that's all for the tutorial. And also for tutorial 5 this week. Okay, tutorial 5 this week. So I have made a note here. Where's this? Here for tutorial 5, it will be this week. So tutorial 5 this week will be on Microsoft Teams. So please join the tutorial according to your tutorial slot that you have chosen, and prepare the answers before the class. Okay, especially for the group that I assign. Okay, for tutorial 9 to 11, 2 and 4, they are assigned to the questions are assigned to group 7 and 8. And for the tutorial 4 to 6, questions are assigned to group 3 and 5. Okay, so prepare the answers, but you do not need um to paste the answer in the tutorial notebook yet. Okay, so you just prepare the answers first before the class.
Okay,
Doc-
Dr. Wenjing, I have a question. I'm
Mm-hmm.
from the group 8. So should
Okay.
we prepare a slide and then can we pre-record or must be live?
Uh, Not a slide. I mean, just how you prepare your answer. It can be in Excel or in Word. So you just share your screen to the class. Okay, and just explain a bit about the answer. So you do not have to pre-record.
Okay, okay.
Okay,
Thank you, Doc.
so you just share your answers, whatever. In whatever format that you use to to prepare the answers. All right. Any other question on the tutorial, or any questions that related to the lecture today?
Sorry, doctor, but just to clarify,
Mm-hmm.
which chapters will be included in the test?
Which chapter? All. Which
Okay, all
is,
right.
yes, all chapters from accounting and organization. Sorry, accounting and organization until up to measurement of business income. Okay.
All right. Thank you, doctor.
All right.
Doctor, what about the format?
Yes. The format will be journal entries. Journal entries and also short answers.
Doctor, for the test is we write on the on the paper and then upload to Spectrum or directly write on Spectrum.
No answer on the paper. So you have to copy and paste the answer on Spectrum answer box. Okay. So you have to copy and paste your answer in the Spectrum answer box.
Okay, thank you, Doctor.
Okay. So you can prepare your answers in Excel or in Words, but then you have to you have to copy and paste in the Spectrum. And if you want to attach the answer, please attach in PDF format. Okay, I will allow only one attachment, so you attach in PDF format. Alright, other question?
The duration time is
The duration is 1 hour.
Doctor, how many question in the test one?
Two question. One question short answers. Another question is to prepare journal entries.
Okay, thank you, doctor.
Alright.
Doctor, the test starts at 9, right?
Yes, 9 a.m. during lecture time. Okay. Other anything else you want to ask regarding the test?
Doctor,
Yeah.
Doctor, for the journal entry, the reference number will be given, right?
Journal entry reference number. What do you mean reference number?
Like there is to represent the account title, right?
No need. Just you make sure that the account name is correct. You debit in a correct account and credit in correct amount, a correct account, and also amount is correct. So just make sure on that.
Okay,
Correct.
okay.
Correct account name and correct amount. So no need
Okay,
to write uh, a reference number. Yeah, and also date. Please write the date as well. Okay. Explanation no need. Okay, explanation usually I give the marks. What is this? The marks to the explanation if let's say if I find the account name is wrong, amount also wrong, so I give kesian mark. If I find that explanation is correct, means that yeah, some sort that the student is understand the transition. Okay.
Doctor, but the explanation is not compulsory, right?
Yeah, it's not compulsory.
Okay, thank you, doctor.
Alright. How can I return to the where's the oh my god. Mm, okay, let's go back to the lecture today. Okay, this is wrong lecture. Not this one. Okay, hold on. Okay. So can you all see our last slide on your screen now?
Yes, doctor.
Yes, doctor.
Right. So here, so basically there are two broad categories of adjustment. One is prepayments and or we call it deferrals. Another category is accruals. Okay. So prepayments or deferral means that when the payment are made or the cash is received before the expenses or revenue is recognized. Okay, so this category includes prepaid or deferred expenses. Okay, prepaid or deferred expenses and also the unearned revenue or deferred revenues. Okay, the second category is when cash is paid or received after the expenses or revenue is recognized. Okay, this is what we call accruals. So this category include the accrued expenses, or we call it also payables. Like, you know, if we have accrued salaries, we also call it salaries payable. So it's the same thing. And also accrued revenues, or we call it receivables. Okay. So you have to understand in accounting, there are many different terms, but same thing. Understand? So the terms are different. Like as you can see here, accrued expenses is also called payables, and then prepayments also we call it deferred. Okay, prepaid or deferred. So it's, you know, there are many terms that can be used. Okay, but it's the same thing. So yeah, so please try to get familiarized with these different terms. Okay, here when adjusting entries is used to convert asset to expense. So here the transaction will take place in a prior period. Okay, that involved in the advance payment. So here it means that the adjusting entry is made at the end of the current period to recognize the converting of the prepaid asset into expenses. Okay, so this is for example like depreciation. Okay, no, not really depreciation. Depreciation, not a good example. Oh yeah, perhaps I give examples of prepaid expenses. Okay, so prepaid expenses. So at first, because the cash is paid in advance, so you have a prepaid expenses or asset. So it will create asset account. So at the end of the year, so we recognize the conversion of the prepaid expenses, asset to expenses. Okay, so in this case here, At the end of the year, we have to reduce the asset account and we increase the expense account. Okay, for example here, insurance. Okay, on the 1st January, the company purchased 1-year insurance policy and pay 2,400 in advance. Okay, the amount was charged to the here uninspired insurance. Okay, uninspired insurance, or this is what we call asset account because it's uninspired insurance. Okay, asset account. So means that here each month we have to reflect that insurance expense is 200 because 2,400 divided by 12 months. So it will be monthly insurance expenses will be 200. Okay. So here is the journal entry that we have to make. Firstly, we record the purchase of the insurance policy. Okay. So the purchase of the insurance policy, we have to debit the prepaid insurance. Okay, debit prepaid insurance or debit unexpired insurance, 2,400. And then we credit or decrease the asset account, which is the cash, 2,400. And monthly, we do the adjustment. So the adjustment would be at the end of the first month, January 31st, we debit insurance expense 200 and credit unexpired insurance or prepaid insurance. Okay, 200. So we have to do this every month. Okay, every end of the month. Now, let's see in the second situation here. Here we convert the liabilities to revenue. Okay, so convert liabilities to revenue means here the okay, the adjusting entry will be, because here liabilities means that we collect cash in advance, but the revenue has not been earned yet. Okay, so here we have an unearned revenue. We receive cash in advance, but we haven't delivered the goods or services. So it's a liability. So at the end of the year, we have to make the adjusting entry. Here at the end of the year, we have to recognize the revenue that is earned during the period. Okay, so this kind of unearned revenue, for example, like if you let's say if you have a magazine company. Okay, if you have a magazine company and you allow subscription, magazine subscription, so magazine subscription will collect cash from the subscriber. Okay, collect magazine is also old fashioned. Okay, let's say you subscribe Netflix, for example, you subscribe Netflix for 90 days. Okay, so Netflix will collect cash for 3 months earlier. Okay, so collect cash 3 months earlier. So at the end of the period, we have to recognize, Netflix will recognize the revenue, okay, that is earned during the period and also reduce the liability account, which is the unearned revenue. Okay, let's see here example on how we convert the liability to revenue. So here the company received 6,000 in advance for 1-year rental contract. So because the company prepare monthly financial statements, so the company should recognize this 500 okay per month in rental revenue. So let's see how we record this transaction. So on the 1st January, we record the unearned revenue. Okay, we record the unearned. We have to recognize the as a liability. So the cash is received, debit cash 6,000, and we credit unearned revenue 6,000. Okay. Next. Okay, I think where's another slide? Slide 34. Can you all see the slide 34 on your screen?
No, doctor.
I don't know
No,
why the
doctor.
slide I don't know why slide 34 is blank here. But anyway, I hope that you have it in your PDF lecture. But here, at the end of the month, okay, let's say on the 31st January, so the company would debit the liability account, or they will reduce the liability account. So they will debit unearned rental revenue 500, and then increase the rental revenue, which is they have to credit rental revenue 500. Okay, for the first month, debit unearned rental revenue 500 and credit rental revenue 500. Okay, so this is what we do it, how we do it in the T account. Just now it's all in journal entries. Okay, so in the balance sheet, we will report the liability of 500 here. Okay, 500, which is this is the balance carried down. Sorry, balance carried down. Sorry, the liability, the unearned rental balance. Okay, um, which is 5,500. And the income statement, we will recognize the revenue earned, which is 500. Okay, so one of the key to understand the accrual of expenses, firstly, you need to realize that expenses that has been incurred in the current accounting period but not paid yet. Okay, because it will be paid in the following accounting period. So in this case here, the cash will be paid in future period. Okay, um, so here you will not record the expenses until the following period when the when the here we will record the expenses at the end of the year only. Okay, so we will delay the recognition of the expenses. Okay, so in the adjustment entry, we will uh, debit the expense account and we will credit the liability account. Okay, debit expense because we have to recognize the expense incurred, and we credit the liability. Okay, to increase the liability. Okay, so let's see an example so that you can understand clearly what is this accruing unpaid expenses. Okay, in this example, this is accrued expenses. Okay, the company here pay, let's say they pay the salaries to the employee every Friday. So at the end of the month, which is, let's say end of the month is May, 31st May. So here they have, yeah, the company haven't paid yet on 31st May, 3,000. The payday is every Friday. Okay, because the payment is only made on Friday. So Friday will be in June already, June 2nd. So from May 29 until 31st May. So we have to recognize the wages expense for the month of May. So how to adjust this? Okay, so in this case here, the company will have to debit expense account, which is the expense account incurred is 3,000, and credit liability account, which is wages payable or accrued wages. Okay, accrued wages or wages payable, credit 3,000 because it's a liability. Okay, so in the T account here, so in the balance sheet we will record 3,000. Okay, under liability, and we report wages expense 3,000 in the income statement. Okay, so every week wages total is 5,000. Okay, so it means that 3,000 is in the month of May, 2,000 is in the month of June. So how to record the entry for June? Because the payment is only made in June. Okay, June 2nd. So that's why we have to carefully separate how much is how much is incurred in May and how much is incurred in June. Okay. Now let's look the entry. So we have to debit 2,000, which is the portion for June, and then we eliminate the portion for May because we already recognize the payable as payable, right? So we have to eliminate the payable account, 3,000. Okay, and then why we eliminate? Because the company already made the payment. Okay, we have to eliminate the payable because the company already made the payment of cash, which is total is 5,000. Alright, now let's see. Next is in case of accruing uncollected revenue. Okay, uncollected revenue, which is accrued here, means that accrued revenue. So this is means that the revenue has been earned, but the cash will not be collected until the next period. Okay, so you have earned the revenue here in the current period, but the payment will be made in future period. So in the adjusting entry, we have to, at the end of the current period, okay, so we have to record the receivable, and also we recognize the revenue earned. Okay, let's see this example. Here the company deposits money in bank. So the account is interest bearing account. So the bank will pay the interest every 50th of the month, 50th day of the month. Okay, so the end of the company's accounting period ended on 31st January. Okay, so from 15th January until 31st January, the interest revenue earned is 170. Okay. But the interest revenue is not received yet. Interest revenue will only be received on the 15th February. But 170 is already earned, okay, because it's already January 31st. Alright, so to record this interest, it will be called as interest receivable because it is earned already, but haven't been received yet. So you will receive in future. So receivable means that you will receive in future. Okay, so we debit interest receivable, which is asset. Okay, debit 170 and we credit interest revenue 170, the same amount. Okay, in the balance sheet, we will report interest receivable as asset, and in the income statement, we report interest revenue as revenue earned. Okay, and okay, let's say from the 1st February until February 15, the interest revenue is 150. So in total, the bank pay here on February 15, the bank pay 320 interest. Okay, it is the monthly interest is 320. So how to record the cash received on the 15th February? Okay, so again, we have to carefully separate the interest revenue for the month of January and interest revenue for the month of February. Okay, so we received the cash in total is 320. Okay, the company received the whole 320 on 15 February. But remember, some portion is in the month of February, another portion in January. Okay, so because it's in the same month, February, so it will be recognized as interest revenue. Okay, the 150 will be recognized as interest revenue. And for the remaining of 170, remember that you already debit interest receivable before and you already recognize as interest revenue. So we have to remove from the interest receivable. Okay, so that's why we credit interest receivable 170. Okay, to eliminate the interest receivable. Okay, so yeah, I do not prepare the quiz on Socrative, but I think that's all for today. Do you have any question before we end the lecture today?
Hi,
Assalamualaikum,
Doctor.
Doctor.
Yes, salam.
I have some trouble to make the attendance in Spectrum because my Spectrum was down.
You
I can log
mean
to the Spectrum.
you mean the attendance for today?
Yes.
Oh no, today because it's a live lecture, so there's no attendance on Spectrum. So I just directly download your attendance on Microsoft Teams. So
Oh,
you do not have to do anything for the attendance today.
thank you, Doctor. Because I cannot open the Spectrum, open my Spectrum, so I don't
Okay.
know. Thank you,
All
Doctor.
right. Okay. Another question?
Hi, Doctor.
Yeah.
Can I
Hi.
ask, is there another name for interest receivable?
Another name for interest receivable. Um, Interest receivable, we can call it accrued interest received.
Okay, thank you, Doctor.
Okay. Or accrued interest revenue. Okay, accrued interest received or accrued interest revenue. What else? But it's accrued revenue. Okay.
All right, thanks, Doctor.
All right. And then the question. Okay, everyone. So if no question, so I think that's all for today. But if you have any question, anything that you are not clear or do not understand, you just message me on Spectrum or Microsoft Teams. Okay. Right. So I think this will be the last lecture from me. Next week lecture until when wait. Let me see again. Okay, let me make announcement when is exactly your what you call it, your test, because your test will be in week 7, but remember week 7 will be handled by Dr. Hanif. So probably your your test is not during the lecture time, but I will try to ask from Dr. Hanif if I can take 1 hour from his lecture time. Okay, so please wait for the announcement. Okay, if not, most probably it will be on Friday. Friday week 7.
Friday, is it in the morning or evening?
Friday morning. Can I know how many of you have class? Okay.
Yeah.
All right. I try to persuade Dr. Hanif to give his 1 hour from his lecture, so that you can do the test. Okay, let me check your course info again. Hold on. So okay. No. Yep. So next week is still my lecture. So yeah. So confirm. Okay. So confirm everyone, because I thought that Dr. Hanif will start next week. Okay, no. Dr. Hanif will start in week 8. Okay. So week 7 is still my lecture, but I will do pre-recorded lecture. Okay. So I will do pre-recorded lecture for week 7, but during the lecture time, which is at 9 a.m., you will do the test 1. Okay, so it's confirmed already. Not on Friday, so it will be during your lecture time. Okay, got it, everyone?
Yes,
Yes.
doctor.
Yes, doctor.
Okay, so I see you all again this Thursday. Okay, for your tutorial, live tutorial. Alright, so happy Ramadan for all Muslim and the rest also. Yeah, hope all of you take care.
Thank you, doctor. Happy Ramadan.
Okay.
Thank you, doctor.
Thank you, doctor.
Thank you, doctor.
Okay, you're welcome.